Hi there everybody and welcome back to another stock analysis video. Today we are going to be analyzing the company Johnson Outdoors, a company that's actually looking very cool because their main products are outdoorsy stuff, which is again really awesome. I love these types of companies. They got fishing, diving, camping, watercraft. It's just absolutely crazy all over the place. Absolutely love it. And this was actually recommended by somebody on my poll that I made on my channel saying, you know what guys, there really isn't that many companies out having earnings this week, so give me some companies that you may want to analyze. And well, we got Viewfinder asking for JOUT and INMD. We're going to be doing INMD later on this week, but right now we're going to be doing a JOUT. So with that said, let's get started with this analysis. Coming right into the dividend summary, guys. Fairly surprising. By the way, starting off, I know nothing of this company. This is the first time I hear about this company, so I'm literally going in blind, okay? So this is actually going to be fairly interesting because this actually might be a very good company. I already saw the numbers when I was putting them in, and I have some opinions about this company, so just stay tuned for those at the end of the video. They do pay a dividend, guys, of 1.94%, which ends up being 30 cents per share for an annual payout of $1.20. The payout ratio, guys, is 20% on the dot, which is again really solid. I like to buy anything under 60 when it comes to a payout ratio in regards to the free cash flow. This is in regards to the net income, but nonetheless, it's still fairly good at 20%. Now, what is beautiful, oh dear lord, gorgeous, honestly, this 5-year growth rate on this dividend, 25.97%. That is insane. This means that within the past 5 years they have grown this dividend on average at almost 26%. That's really good, guys. Okay, yesterday we did MasterCard and it was at 17.8, and I said that was amazing. 25.97 is just incredible. And on top of that, they also have 8 consecutive years of paying out this dividend, which is, again, it could be better, right? I would like it to be a little bit higher, but 8 years is still really good. And as you can see right here, taking a look at the dividend history, they've been paying a pretty consistent dividend within the past several years too. Now, if we go over here to the maximum, they did have a gap ending their dividend late 2008 and then starting it back up as of late 2013, probably because, guys, of the financial crash that happened. At least this is my opinion. Maybe if you know the reason why they cut this dividend between this range, but if I had to guess, guys, it was probably because of the 2007-2008 crash that occurred. But nonetheless, this is still looking fairly good. Ex-dividend date is actually coming up as of July 13th. Payout date is July 28th, and they pay their dividends quarterly. Taking a look now into the calculator, we got the ticker symbol of JOUT, JOUT, market cap of really tiny, $628 million. It's a pretty small company, and this actually has a PE of 11.09 with a current share price of $60.76. This actually, guys, might be a fairly good price tag to buy this company at in accordance to their PE. We're going to take a look at other metrics, come up with a more reasonable intrinsic value, but just based on the PE, this is looking amazing. Okay, this is looking very good so far. Now, looking at this $1.20 annual dividends further, we can see that based on their shares outstanding, they pay out, guys, $12.12 million every single year in dividends. And after this dividend is paid, in regards to their 5-year average free cash flow, they're still left with $26 million, which gives us a payout ratio in regards to the free cash flow of 31.76%. Still fairly low. I personally like to buy anything under 60, 31.76. This dividend is 100% safe. Taking a look now at some fundamentals, starting of course with the net income 5 years ago of $35.2 million to 1 year ago of $83.4 million. That's an increase, guys, of 137%. And on top of this increase on the 5-year, guys, this is very consistent, which is something I love to see. Right, from 5 years ago to 4 years ago to 3 years ago to 2 years ago, they were slightly increasing. Now, kind of the anomaly here is the fact that 1 year ago, they shot up to 83.4 million, whereas 2 years ago, it was 55.2 million. What is surprising here, though, is the fact that when COVID hit 2 years ago, they actually did a little bit better in their net income than they did 3 years ago. Now, the anomaly is the fact that 1 year ago, they just shot up going to 83.4 million, up from 55.2 million. My explanation for this is probably because a lot of people were really tempted up, people wanted to go outside, and people just decided to buy stuff and they went outside. So that's essentially why I think the 1 year ago number is that high, but nonetheless, really good solid net income. Now let's take a look at the free cash flow. This unfortunately isn't looking as hot as the net income, which is kind of worrying, but nonetheless, we got 5 years ago of $34.8 million to 1 year ago of $36.9 million. On the 5 years, guys, this is an increase of 6%, with a 5-year average free cash flow of 38.16. Now, free cash flow, guys, is the most important profit metric that we have, because every investment is the present value of all future cash flow. And you want this number to be positive and of course consistently increasing, because free cash flow is what companies use to pay out a dividend, to buy back shares, to pay down debt, to make acquisitions, and to generally grow the company. So you can see here, yeah, this is an increase of 6% on the 5 year. However, it is pretty much all over the place, right? 5 years ago, 34.8, 4 years ago, 44.2, 3 years ago, they went down to 29 million, and then 2 years ago they went up to 45.9, and then 1 year ago they went down to 36.9. Now, something that really did concern me here, guys, is that, well, when it comes to free cash flow, the way that this is calculated is cash from operations less your capital expenditures. What concerns me here is that when I actually took a look at this cash from operations and capital expenditures, I found that essentially the current cash from operations, TTM, is negative $34.4 million. And that's not good, because, well, when we do negative 34.4 plus a negative 27.3, we get a really bad negative number. So I don't necessarily know why the current one is so low. Maybe some of you guys may have some insight onto this, but just looking at these numbers, this is looking okay. And then come to today, yikes, that is not looking bad. I don't necessarily know what's happening here, but be wary of that number, especially when we go into next year and all of this slides over 1. So understand that. But as it stands, guys, the free cash flow, it is positive, but it's just not consistent enough for me to fall in love with this. And now looking at the last profit metric, we got the revenue. 5 years ago of $490.6 million to 1 year ago of $751.7 million. That's an increase of 53.22%. And it's looking, again, really good, similar to that of the net income, actually. Fairly steadily increasing from 5 to 2 years ago. And then 1 year ago, they shot up almost $150 million. That's actually really good. Taking a look now at some balance sheet numbers, total assets minus the total liabilities. Guys, if the company has more liabilities than assets, this means that they will not be able to weather a recession, which, let's face it, we are probably in one right now. So you want this number to A, be positive, and B, be growing, essentially, be growing. You want their assets to be growing more than their liabilities. And you can see right here, they currently have $474.6 million in assets minus liabilities in the positive. And on top of that, guys, from 5 to 4 to 3 to 2 to 1 year ago, they have been consistently increasing this, which is really good. Average total assets is around $512.5 million. Average liabilities is around $152.9 million. And doing this difference, we get $359.65 million. Now, coming over here to the shares outstanding, the metric that companies tend to fail because people tend not to look at it. People tend not to care. People think that, oh, issuing shares doesn't really affect me in any way. It does, because when a company issues shares, they're diluting you as the investor. So you want this number to be coming down. Now, when it comes to this company, well, it is an increase on the 5 year, going from 5 years ago of 9.8 million shares to today of 10.10 million shares. Increase of 3.06%, and from the previous year to the current year, this is looking at 1 year ago of 10 million shares to today of 10.10 million shares. This is pretty much just telling me that, well, they're issuing shares, yes, they are diluting you, yes, but it's not that bad. In my personal opinion, when it comes to issuing shares, if you see anything above 0 and 5%, I see them just doing this because they feel that their stock price is overpriced, or maybe they just want to issue shares and not have the liability in their balance sheet, so they just decided to issue shares instead, and then maybe in the future they'll buy back. So 3.06%, it is an increase, but it's not that bad of an increase. For all intents and purposes, yeah, this is a negative metric, but it could be a lot worse. And lastly, looking at the cash equivalents, they currently have $113.2 million with an average cash of $154.02 million. Now let's make some assumptions, low, medium, high, using 3 different factors. Now, guys, as you can see, these ones are blank because I want to do it with you guys. I want to fill them up live so that way you guys can see how these numbers actually change. So, looking at the revenue growth assumption, we're going to come over here to Seeking Alpha's growth tab. And as you can see, the revenue growth year over year is 7.12. Revenue growth forward is 8.26. My job as an investor, guys, is to be conservative with these numbers. So, based off of this, I am going to make a low, medium, high assumption when it comes to this company. So, being conservative, I think that for the revenue growth assumption, I'm going to put it at 5%, guys, for the low assumption, 6% for the median assumption, and 7% for the highest assumption. Now, you're probably wondering, well, I mean, the highest number here is 8%. Why are you putting it at 7? Again, my job is to be conservative. Even at my highest assumption, I need to be as conservative as possible. I think 7% is a fair value for the revenue growth assumption. Now taking a look at the share buyback. Let's take a look now at the shares outstanding graph that we just saw. So we can see they have increased shares at 3.06% on the 5-year and 1% on the previous year to the current year. So for the low assumption, let's say that they'll continue to issue shares at around negative 3% within the next 4 years. For the median assumption, let's say that they'll continue to issue shares, however, at negative 1%. And lastly, for the high assumption, let's say that they stop issuing shares and that they start buying back shares at 1%. So now that we have all of these numbers, guys, as well as the required rate of return, I like to keep it flat at 10%. We got the target share prices. You can see right here for the low assumption, we have a target share price of $74.48. For the median assumption, it is $78.63. And for the highest assumption, it is $83.01. Now let's adjust for debt. And boy, these numbers caught me off guard when I first saw them. But the way we adjust for debt is we take the cash equivalents, we take the net debt, we add them together, we add that to the market cap, and if a company has more cash than debt, this number comes up. And if a company has more debt than cash, then this number comes down. So you can see it does come up a pretty big amount, right? For the low assumption, it is now $159.83. For the median assumption, it is $168.38. And for the high assumption, it is $177.34. Now, you guys are probably wondering, $159.68.70. So what? That's insane. Well, let me just show all of you guys where I'm getting these numbers because this isn't something I'm making up. Coming over here to the balance sheet, we can see that their net debt is in the negatives and has been in the negatives. Now, this has been decreasing, but nonetheless, currently, guys, they are at negative $64.9 million when it comes to their net debt. And if we actually scroll all the way up, we can see that the current cash equivalents, as we just saw, is $113.2 million. So that essentially explains why these target share prices after debt are so high, because they really have a lot more cash on hand than they do debt. So that's essentially why we get them this high. Now, on top of these target share prices after debt, I also like to add a margin of safety of 5, 10, and 15%. And in doing so, this puts me between the range of $135.86 to $151.84 for the low assumption. For the median assumption, it is $143.11 to almost $160. And for the high assumption, it is $150.74 to $168.47. Guys, the current share price is $61.76. So, looking at these target share prices, guys, this actually might be fairly good buy right now, right? I mean, $61.76, fairly good. At my lowest assumption, target share price, not adjusting for debt, we got $74.48. So just right then and there, you are gaining almost $13 in revenue, assuming that you believe my assumptions, right? Again, all of these numbers are based off of these assumptions that I have right here. You guys saw me input it, you guys saw the numbers change. So just because I have these numbers doesn't mean that you should follow them. In fact, you shouldn't, because this is not financial advice and every investment is the present value of all future cash flow. I have this calculator, guys, available for free. Anybody could have it, as well as my book value calculator and a recalculator, and on top of that, a dividend tracking sheet similar to the one you're looking at. However, it is empty. So I'm giving you guys these 3 free calculators as well as a dividend tracking sheet because I believe that you guys should make your own assumptions. You should not follow mine, make your own, because if you think that maybe JOUT might be making a lot more revenue, or maybe you think they'll do less revenue. Maybe you want a higher required rate of return. Maybe you want a lower required rate of return. Maybe you want a higher margin of safety. Whatever it may be, right? The fact of the matter is that you guys should make your own assumptions and see what prices you guys should be buying this company at based off of your assumptions. Again, free calculators and a dividend tracking sheet. All I'm asking for in return, guys, is help me grow my channel. If you think I'm doing a good job, if you like this kind of content, just help me grow. Like, subscribe, comment, share with your friends, right? We're in a really tough market. The market has been red within the past several months now. And I think it will continue to get worse. So if you have friends or family that may want to learn how to invest now, maybe they don't know what to do, maybe they want to have a process to investing, tell them to check out my channel. Again, all these things are free. Just help me grow my channel. That's really all I'm asking for. Can't thank you all enough for those who have already subscribed, who are commenting, who are liking. Thank you all so much. Really appreciate it. Now let's take a look at this dividend, because this company does have a very good dividend CAGR, and as well as a pretty good dividend at $1.20. So let's say that you make the average US income $68,703. If you were to put 1 month's income into this company, this would actually buy you guys 92.7 shares. And at the current annual dividends per share, this is netting you $111.24 annually, quarterly dividends of $27.81, and a monthly dividend of $9.24. Now, $100, guys, is actually not too shabby. There are a couple companies out there that pay in the likes of like $200. I know ET does, but then again, guys, this company has a pretty big CAGR. I mean, 26%. That is massive. If you think that they'll continue to increase it at around this range at 26%, you are looking very, very pretty, assuming that you buy it right now and that you believe these assumptions, right? So this kind of dividend is looking very, very good for a company like this. All in all, when it comes to JOUT, honestly, I think you may have found a gold mine when it comes to this, because this is looking fairly good pretty much all over. Now, my 2 points of congestion is the fact that their free cash flow isn't that consistent, and the fact that we just saw their cash from operations going negative this year. That's a little bit concerning. And the other point of concern is the fact that they are increasing their shares a little bit though, but they're still increasing your shares. So yeah, not that good when it comes to that. But aside from that, guys, if you know why their free cash flow is negative, or if you know why their cash flow has been all over the place, and maybe you know why they've been issuing shares, then by all means, guys, this is a pretty good looking company to buy, even for a dividend play as well as just overall growth. That pretty much is it for this video. Like if you like, comment, subscribe. It really does help here with the algorithm on YouTube. You guys can follow me on my new tech sites as well as the Let's Play channel. Link is in the description below. So with that said, peace out. Be on the lookout for the next stock analysis video.